Investing is a simple enough thing to understand, but that doesn't always mean that it's an easy thing to do well. As we've seen in the asset allocation series on this channel, history suggests that in the vast majority of cases, if you go with a well-diversified, broad-based investing strategy, you'll likely make money more often than not. Over the long haul, we're usually talking somewhere in the neighborhood of 6 to 8% per year over and above inflation, depending on which specific allocation you've decided to go with. However, that isn't the experience that many investors end up with. Even though the investing strategy they initially chose to go with ends up earning roughly that much, investors often come up short. Why is that? Why do the investing strategies we choose so often fail us as investors? And what can we do to help ensure that we get the most out of our investments, regardless of which allocation we ultimately end up going with? That's what we're going to be talking about today. Let's discuss what I consider to be the 3 primary drivers of investor underperformance, why they exist, and how to avoid them as much as possible. But before we get going, be sure to like this video if you haven't already, as it really does help out the channel a lot, and subscribe with notifications on for more money-related videos like this one every single week. And if you want to further support this channel, you can check out some of the links I've left in the description below, which includes a link to my Patreon page. This is the best way to show your support for this channel, and in addition to that, you can also get early access to new videos and exclusive content such as spreadsheets based off the ideas we discuss in these videos. The spreadsheets will allow you to play with your own numbers and see how big of a difference some of the ideas we discuss can make for your own personal financial situation. The first reason why an allocation could fail us is because we don't accurately anticipate our reactions to the emotional struggles that come with economic downturns. In other words, we underestimate the importance of tranquility, and to an extent resiliency, when choosing our allocation. Of course, during times of economic turbulence, our emotions don't have to fail us for our allocations to. If you lose your job and need to sell some of your investments to put food on the table, then tranquility and resiliency are just as important to you realizing the best possible outcome long term as growth is. This is because selling investments, whether out of fear or just because you have to, when they're 50% below all-time highs for 2 years, is going to do a heck of a lot more damage to your overall growth and ending net worth figures than selling at 20% below previous highs for a year before the investment recovers, at which point you're selling at all-time highs for the following year. Just to put some actual numbers to it, let's say that you choose to invest in an all-stock allocation. Typically, all-stock allocations produce strong long-term growth, often around or even slightly above that 8% per year after inflation threshold. But they aren't always very tranquil relative to many of the other allocations that you could choose, due to that short-term volatility that they sometimes experience. We'll say that for the first 5 years, John is investing $1,000 a month and earning 8% on that investment. But then in year 6, his investments fall by 50%. Unfortunately, at the same time, the economy and the job market struggles to recover until the start of year 8, at which point John has lost his nerve and changes to a less volatile investing strategy going forward. On the other hand, Jane decides to go with a more tranquil investing strategy from the start. It earns only 6% per year after inflation, but at least when the market crashes in year 6 and 7, Jane's investments will only fall by 20%. We'll assume that she's investing the same amount of money as John. John will obviously come out ahead in the first 5 years under these assumptions, because they're investing the same amount of money, but John's investments are earning more. However, they also fall more when the market crashes, which raises 2 questions. Number 1, will John's edge in returns be enough to even out the losses he experiences in that 6th year and keep his net worth ahead of Jane's? And number 2, if it isn't, how long will it take before John's net worth once again surpasses Jane's, which it inevitably will if there are no other crashes? The answer to the first question is a pretty resounding no. In fact, even by the time year 8 rolls around and the markets have begun to recover, John's net worth would be something in the neighborhood of $67,000. Jane's is over $81,000. The answer to the second question depends on how John's new investing strategy performs. If he goes with a more tranquility-focused one like Jane, he may never actually earn enough to catch back up to her. And given what he just went through, it wouldn't surprise me if he did something like that. But if we say that he just changes to a less aggressive growth strategy that still earns him a solid 7% per year after inflation, then the answer would be somewhere in the neighborhood of the 222nd month of the simulation, or 19 years and 6 months into it. So it takes nearly 13.5 years to claw his way back to even with the less growth-focused approach. And that's assuming that no other major crashes happen during that time. Beyond that, we need to ask ourselves, how much money did John leave on the table by underestimating the importance of tranquility to his long-term financial success? What would John's net worth have been had he just used the less aggressive growth strategy from the beginning? Well, if we assume that it had real returns of 7% per year, and due to being less aggressive didn't fall by quite as much when the markets crashed, we'll say it drops by 35% in that 6th year instead of 50, then John's net worth would have been a little under $2.28 million. So in other words, it would cost him nearly $70,000. The second reason why an allocation could fail us is because we become impatient as time goes along. Impatience often sounds something like, every time I look at my bonds, they're going down. Or, my investments are not going up fast enough to fund my retirement or reach my financial goals. Or even just something as simple as, my bonds are not going up as fast as my other investments like my stocks. I think maybe I should sell them and move my money into other investments like stocks since they're doing well. In other words, we grow impatient when we underestimate the importance of growth and/or consistency when choosing our asset allocation. This can lead us to frequently changing our asset allocations, which, as we just saw a minute ago, can often end up netting us lower returns than we would have had we just stuck with the original plan or a plan that was more well suited to us from the beginning. Beyond what we saw in the previous example, we can sometimes net lower returns due to things like incurring higher taxes and trading costs, which can more than offset the gains we received by shifting allocations, if in fact the new allocation ends up gaining more, or because this pattern of impatience-fueled asset reshuffling eventually leads us to make mistakes in other ways, which leads us to the third reason why an investor may underperform their allocation. The third reason why an allocation could fail us is because we fall prey to BBD syndrome. BBD syndrome, or the allure of the bigger, better deal, is sometimes referred to as greed and speed tactics when put into action. It usually takes the form of someone changing their allocation, or even their entire investing philosophy, in order to try and make a quick buck on an asset or investment that has recently been experiencing a major run-up. Recent examples of this include GameStop and other meme stocks. Obviously, some people do find great success with these tactics on occasion. I mean, they likely wouldn't still be in use today if that weren't the case for some people, but over the long haul, it has not proven to be a winning strategy. This is partly due to a phenomenon known as mean reversion. Basically, unless something has fundamentally changed with the asset or investment in question, it's unlikely to be able to sustain those significantly elevated levels of growth for too long. And if you're thinking about changing your investing strategy to get in while the getting is good, you should probably stop to consider how long its super growth cycle is likely to last and whether or not the majority of the rewards have already passed you by. If you don't, you run the real risk of buying in at or shortly before the peak before watching the investments fall back down to earth along with the value of your nest egg. And unfortunately, due to cognitive biases such as anchoring, recency bias, loss aversion, and disposition effect, you may find it more difficult to sell your losing investments as early as you probably should in that case. Basically, this driver comes into play when we underestimate the importance of dependability when choosing our asset allocation. These drivers of allocation failure can also lead to other decisions, especially as our time horizon shrinks for some of our bigger goals. Some examples of these decisions are starting to use leverage or margin trading to increase growth and/or maximize the value of a short-term gamble trade. For example, those who were investing in meme stocks recently, it was clear to everyone that they were a risky bet, but they were still being bought in part because there was a chance to make a seriously quick buck off of them. Other examples include engaging in day trading and/or just trying to time the market in general. We all know that all of these things can and do work sometimes, and like I said, even the meme stocks did work out for some, but they all also carry with them increased risk of underperformance, sometimes to a staggering degree, against a version of ourselves that didn't engage in such tactics. Therefore, these drivers behind investor underperformance should be at the front of our minds when trying to choose the best allocation for ourselves. And we should also keep in mind that due to the varying financial situations, personalities, risk appetites, and experiences that we all have, some of these drivers will have a larger impact than others depending on the individual. So we need to be honest with ourselves and plan accordingly for us. So when choosing your asset allocation, don't just think short term like John did. Don't just focus on one aspect of an allocation because it looks really good, and don't just look at someone else's process and copy their allocation because it looks good on their white paper. Life is not lived on paper. And while as investors we do have a great many things in common, you'd be hard-pressed to find two situations that are really exactly the same. For instance, someone who is nearing their desired retirement age but cannot save very much money each month may favor growth and dependability more than consistency, tranquility, or resiliency. They need their money to make them quite a bit of money in order to reach their goal in time, but they also have to balance that out with the need to avoid a lost decade due to the limited time horizon that they're facing. However, if that same person had an extremely high savings rate, they may favor something like consistency above all else, with growth being a secondary consideration and tranquility and resiliency being far less important. This is because their savings rate would be doing most of the work for them in terms of building wealth, and large downturns with slow rebounds could actually be considered a bonus to some degree, as long as, of course, the recovery is complete by the time they pull the trigger on retirement and doesn't cause them to fall victim to any of the potential traps we discussed earlier. And if the year-to-year consistency of returns were generally within a few percentage points of each other, the time it would take to reach financial independence, even in slightly less than ideal circumstances, circumstances would be far more reasonable and predictable. Obviously, the savings rate is just one of many factors to take into consideration when choosing your asset allocation, but you get the idea. So don't be afraid to take your time before making your decision. Consider all your options and think about how they stack up against each other in terms of helping you to achieve your specific goals. Because in the end, the best allocation is not necessarily the one with the best after-the-fact growth figures. It isn't necessarily the one that's the most consistent, dependable, tranquil, or resilient. Oftentimes, it's the one that you'll actually be happy to stick with for the long run. But that'll do it for me today. Once again, if you enjoyed this video, be sure to smash that like button if you haven't already, subscribe, and hit that bell next to my name so you'll be notified of all my future uploads. I generally upload every single Monday, and if you have a friend that would be interested in this kind of content, be sure to share it with them. Let's really get this information out there and start our own financial revolution.